UK house prices have fallen for the 5th month in a row, and today we're going to not only look at the regions most affected by this, but we're also going to look at some really interesting information around why house prices won't bounce back potentially as quick as many hope, and also why they could fall even further than many are predicting. So with that, let's jump straight into it. Now, the average house price last month was 258,297, and all regions across the UK have seen a slump in house price growth in recent months, but some are experiencing a sharper downturn than others. And I'm just going to quickly bring up this infographic for you guys just to take a look below at the ones that are most affected. We can see even in the West Midlands, a little closer to home for myself, house price growth has slowed to 6.1%, down from 12%. However, there has been some positive news for those of you up in Scotland, who are actually the least affected region so far, with growth there at 3.3%. down from 7.8%. Now, the typical property value is now 3.2% lower than it was in the peak of last August. So I'm sure many of you remember when that was when I really started screaming that we could now start seeing the start of the property market changing direction and potentially crashing. So anyways, let's look into these really important articles that I think you guys need to know. Firstly, why Britain's falling house prices will not bounce back. Recent reports have come out stating that homeowners should brace themselves for a longer downturn than the 2008 market crash. And there's actually quite a lot of statistics around here which actually make some sense. Now, we know that values are down by 3.2%, as just mentioned earlier, which essentially means the average home is now worth £15,454 less than the end of last summer. And data has confirmed that Britain may potentially be facing its worst housing market crash since the financial crisis, and leave many homeowners asking, how bad will this get? Now, I'm going to dive into that article because this is a really interesting one with loads of stats and figures, but just bear with me for now. Analysts also believe that the current house price slump will not be as big as the one during the financial crisis. However, they believe it will last much longer. So a deeper recession, perhaps, something that we have mentioned on this channel before. Now, during the credit crunch, we know that house prices fell for 16 consecutive months, according to Nationwide. And this time, the analysts at Oxford Economics expect the slump to last 24 months. That's a significant amount of extra time there. And what I do want to just show, along with some other infographics that I have coming up, is the house price downturn, as predicted by these guys, is that it will be shallower but last longer. And here we can just see some forecasts. However, while the slump will be prolonged, Oxford Economics forecast prices only dropped by 12% from peak to the bottom, compared to an 18% crash which was recorded in 2008 to 2009. And Andrew Goodwin of the Oxford Economics states that we think the much higher share of fixed rate mortgages now may potentially limit the fall in prices and make it less steep but more prolonged. Again, time will tell, but it's always good to know this earlier rather than the news hitting you guys and all of a sudden you're refinancing, or you find that moment happening and you're thinking, how did I end up here? Now, the biggest driver of house price falls is the extent to which people are forced to sell. And that happens for many people if maybe they lose their job, or if the cost of their mortgage is too big for them to keep going. Something I do worry about and have mentioned many times on this channel. And more recently, as the Bank of England has begun raising interest rates from the end of 2021, we did see homeowners rushing to remortgage and lock in the cheaper rates. However, by the end of 2024, my friends, it will have nearly doubled to 3.92% according to the Capital Economics forecast. And just very quickly, I'm going to leave this infographic here as well because some of you may be interested, but it just shows the interest rate rises hit the housing market more slower now. Moving on, one thing that we must know is that fixed rate deals cannot protect homeowners forever, as there's an estimated 1.8 million homeowners who will be coming towards the end of their deals in 2023, something I'm sure you've heard me scream enough about. And they will unfortunately have to refinance at much higher rates. And I just recently did a video about Santander as well, which I think I will touch on just at the end of this video. Now, 7.4% of mortgage holders will be looking for new deals in the first 3 months of the year, with a steady flow for the rest of the year. And essentially, more homeowners will come to the end of their fixed rate deals this year. And as we can see here, this is essentially what we're looking at. Now, one thing to note is that people refinancing during 2023 and 2024 will also be struck with higher rates for longer, even as the Bank of England eventually begins cutting interest rates, Mr. Goodwin says. And he states that those two factors mean that we are unlikely to see a big bounce in the housing market. Now, one thing I will say is the speed and scale of the price declines is just one way to compare the two market slumps. Another thing we must talk about, and something I speak about a lot on this channel, is affordability. Mortgage affordability in the years to come will depend on how high interest rates go and how long they stay at those levels. Now, this infographic here shows that it will take years for affordability to recover. And why I like this is because we're not sure if the base rate is going to be increased again, but what we have here is if bank rate peaks at 4%. We have some forecasts here, and we also have it if it's 4.5%. So again, an interesting infographic that some of you may find useful. Now, if the bank rate rises to a higher peak of 4.5%, we know one thing: housing affordability will be as bad as 2008 by the end of 2024, which again is quite worrying. And one thing Mr. Rubinson says, who's part of RICS, i.e. the Royal Institution of Chartered Surveyors, I don't think the housing market will bounce back in the near term in terms of prices or activity. So again, worrying for, I suppose, some investors. I mean, it's worrying for myself as we're building 20 plus houses. Where is the market going? Now, this is where things get a little bit interesting. Why house prices could fall even further than feared. And we're going to look at some charts that they're not too optimistic, but again, I think it's really useful information for you guys. So homeowners now have more debt. And when I first read this title, I thought, what is going on here? However, they are far less riskier lending now compared to 15 years ago, which of course was down to the regulations introduced in the wake of the 2008 financial crisis. But Adam Slater of Oxford Economics, who's an analyst, said that evidence suggests the average homeowner now has actually more debt in proportion to their earnings. And there's a few factors for this, obviously the whole wage thing and also the way the property prices have risen in the last few years. Now, I'm just going to quickly show you this. So there are fewer high loan to value mortgages now, but more homeowners actually have more debt. And since 2007, the share of buyers taking out mortgages with a 10% deposit or lower has dropped by 2/3, from 14.7% to 5%, according to Oxford Economics, which in theory should mean that homeowners are now more protected from house price falls. At the same time, however, the share of joint income mortgages, which account for 60% of the total in the UK with a debt to income ratio of at least 3, has doubled to 40%. Now, as I mentioned a few moments ago, this is because house prices have climbed much faster than earnings over the same period. Now, the result is that there are far fewer riskier loans out there, so the type that was abundant before the financial crisis, but the average homeowner is now unfortunately more exposed to debt. And this essentially means that people are more vulnerable to an income shock, and maybe they have stretched themselves to the limit. And it's interesting seeing this on a report because you've probably heard those exact words come out of my mouth many times. Now, if a property has a mortgage that is relatively small in proportion to, let's say, the combined salary, and one person loses their job, there is still scope to make adjustments and continue making those payments. However, if the mortgage is very large in relation to the income, that buffer zone may not exist at all. Plus, of course, the cost of living on that, but we'll touch on that in a few moments. Alongside this, we have the slow burn of interest rates, my friends. Mortgage rates have jumped from a low of 1.5% at the end of 2021 to more than 5% today, which has hammered buyer affordability. Monthly repayments are so high, especially on those with a high loan to value ratio, that house price falls are unavoidable, according to Mr. Wishart. And I'm just going to quickly bring up this infographic here, which shows mortgage affordability in London will actually be worse than in the financial crisis. So here we have percentage of median full-time disposable income for mortgage payments. Now, even if we assume average mortgage rates fell 4 to 4.6% a year for the typical first-time buyer to keep up with their payments, they would need to cut their home buying budget from $263,000, which it was at the end of 2021, to $220,000 by the end of 2023. So there's a £43,000 drop there, or should we call it a 16% house price fall, just in terms of like their affordability. But this is only a threat on the demand side, which is cutting potential buyers' budgets. The real question for house price outlook is what point are sellers going to have to start accepting lower offers? And I know many people say that if they're in trouble, they just won't sell it. That's not how it works. If you can't afford it, you got that bank knocking on your door, it's a different story. Now, this is where the higher debt burden is key. The more borrowing a homeowner has taken on, the more magnified the blow of higher interest will obviously be. Hence why you got some investors who will leverage up to their eyeballs. Shit's really going to hit the fan for them when they go for refinances. Now, you're probably thinking that things may be a little bit different here. What about the employment market? Well, this article goes on to explain that why the employment market can't actually save house prices. Homeowners have been stress tested against higher rates, so in theory, they should at least be able to afford higher payments, provided they don't, of course, lose their jobs. But higher mortgage rates are hitting homeowners just as they are grappling with a record jump in energy prices, the highest rate of inflation in 40 years, and the biggest drop in real earnings since records began. And to top it off, unemployment is expected to rise. So again, what a damning statement there, but all backed up with facts. And one thing we do know is that mortgage arrears can worsen the economic outlook in two ways. Homeowners will have less money to spend, but also if the banks are losing money on their loans, they then will essentially tighten their credit conditions for all lending, making that lending a little bit more difficult. Now, the long-term economic outlook is bleak according to this article. On average in the UK, the mortgage debt to income ratio is 99%, which is actually much higher than in America, where it's 64%, but lower than the Netherlands, where the ratio is 174%. So the UK kind of sits in the middle of the 18 major economies, at least by a ranking done by Oxford Economics. And this graph just shows all those 18 countries mentioned. So we kind of fall here between New Zealand and France. So it's going to be very interesting. Now, I found a few articles, my friends, just on slightly different topics, is UK house builders are now retreating amid property downturns. So despite everyone saying I'm scaremongering it when I talk about some uncertainty in the market, well, even the biggest house builders are now getting cold feet. And essentially they're cutting back on new projects as they adapt to a downturn in the property market, adding to fears that national housing supply crunch is set to worsen. Now, FTSE 100 developers Taylor Wimpey, Persimmon and Barratt Developments all said in updates this week they would ease up on buying new land and developing it. The trio pointed to economic uncertainty, a jump in mortgage rates and the imminent end of the government's Help to Buy scheme as reasons to be cautious. Spiraling costs for homeowners have contributed the most to cooling of housing markets in recent months. And Persimmon estimated that the monthly cash cost of mortgage payments for some first-time buyers has approximately doubled over the past year due to withdrawal of the Help to Buy equity loan and a jump in mortgage rates. This has essentially forced prospective buyers to pause their searches, and according to Persimmon, it's still too early to predict that there will be any recovery in demand. So, as a result of this, the developers are hunkering down as a result, reining in on buying new land, freezing hiring, and actually weighing up job cuts. And we know that collectively, these three companies built 50,000 homes last year, and a slowdown in construction would have a material impact on the UK's housing market. But it gets worse because Taylor Wimpey has also launched an internal consultation which could lead to redundancies as the business looks to cut 20 million in annual costs, according to Daly, who is the chief executive of Taylor Wimpey. Now, house building across the UK we know peaked in 2020 when 242,700 new homes were built, which was still some way short of the government target of 300,000 by 2025. But since then, development has slowed, and Sunak himself has indicated that he will abandon the 300,000 target as well as roll back from planning reforms which would have made new construction in parts of the country much more straightforward. So it's not looking good from a development side and especially from a supply side there. And then we have an article that I did do a short on, so many of you have probably seen, with Santander predicting house prices to fall by 10% this year. And again, I thought this would be interesting to share with you guys because the lender has revealed that it's actually 400,000 of its borrowers are due to come off fixed rates and are expected to face a £313 increase in repayments a month on average, while the bank has also seen energy bills double year on year for 900,000 of its customers. So again, my friends, this is why I'm a little bit worried about it, and I just wanted you guys to know what's going on. So hopefully you found that useful. If you did, obviously smash up that like button, and I look forward to speaking to you next time.